The UK's national debt is spiralling out of control, and let me be clear, this isn't just a distant macroeconomic issue that economists debate in white papers. It's something that's going to directly affect your margins, your investment decisions, your cash flow, and ultimately your freedom to grow and protect wealth. If you're running a business, managing a property portfolio, or building assets of any kind, you're not operating in isolation. You're operating within a financial system, and when that system is under stress, so is your ability to move freely within it. Let's talk about where we are right now. As of March 2025, UK government borrowing for the fiscal year came in at £151.9 billion. That's not just a big number, it's £14.6 billion higher than forecasted. And in the world of fiscal planning, that's a red flag. This is now the third highest borrowing figure in UK history since 1947, surpassed only during the financial years of 2009 to 10 and 2020 to 21. And what does this mean in real terms? It means that public sector net debt now stands at £2.64 trillion. That's roughly 95.8% of our GDP, nearly a 1-to-1 ratio between what we owe and what our entire economy produces in a year. Let that sink in. And here's what's worse. We're not on a path to stability. We're on a path to escalation. According to long-term forecasts by the Office for Budget Responsibility, UK debt could balloon to over 270% of GDP by the 2070s. To put that in perspective, that's 3 times the size of our economy. You don't need to be an economist to know that that doesn't end well. So what's driving this? Well, there are multiple factors and none of them are short-term or easily reversible. We have an aging population, which means more money going out in pensions and healthcare, and fewer working age people paying tax into the system. Inflation, while easing a little, has driven up the cost of everything, including interest payments on government bonds. We're also seeing ongoing fiscal obligations around climate targets, infrastructure investment, and rising welfare costs. But perhaps the most silent and dangerous factor is interest itself. In May 2022, before interest rates peaked, the UK spent £7.6 billion in a single month just on interest payments. That was a record, and with rates having hovered above 4% for over a year now, we're likely burning even more each month just to service existing debt. Not to pay it off, just to keep the lights on. So then comes the inevitable question. How does the government bridge the gap? Option 1 is spending cuts, but politically that's near impossible. Cutting the NHS, schools, public sector pensions? No government wants that on their hands, especially not with elections looming. Which brings us to the more likely option, taxation. And this isn't speculation, it's already happening. In October 2024, Chancellor Rachel Reeves implemented £40 billion in tax increases. These were described as progressive, but in reality, they hit a wide range of people and sectors. Employer national insurance raised to 15% on salaries above £5,000, and a sweeping new 20% inheritance tax was slapped on rural estates worth over £1 million. These are not niche taxes targeting the super rich. These are broad-based tax changes that affect SMEs, family-owned businesses, farmers, landlords, basically anyone trying to operate efficiently in a market-driven economy. And let's be honest, these changes have consequences. If you're running a business and you employ people, your wage cost has gone up. You're now paying significantly more in employer national insurance, and that comes straight off your bottom line. That's less to reinvest back into the business, less to build financial reserves, and less to spend on developing new products, services, or innovations. For some, that may mean reducing headcount. For others, it may mean raising prices just to survive. And when businesses are forced to raise prices, it feeds inflation, which, ironically, increases the cost of debt even more. It's a vicious cycle. Now, let's turn to property investors. You're probably already feeling the squeeze. You've been dealing with the aftershocks of Section 24 for years, where mortgage interest is no longer fully deductible. You're paying more in capital gains tax. You're facing tightening regulations around energy efficiency standards. And now, with borrowing costs elevated and inflation eroding real returns, your investment risk is increasing while your upside shrinks. It's no wonder that many landlords are exiting the market altogether. According to estate agency data from late 2024, Over 35,000 landlords sold up in just 12 months, many citing that tax changes and policy uncertainty as the main reason. But here's where things get even more serious. The wealthy are already leaving, quietly but consistently. Family offices are relocating to Dubai, Geneva and Singapore. Hedge fund managers are shifting operations to Abu Dhabi and the Channel Islands. Wealthy retirees are obtaining golden visas in Portugal, Spain and Malta, not just for the weather but for the tax stability. Some are setting up trusts in the Cayman Islands or family foundations in Liechtenstein, or even managing investments through Singapore-based holding companies. These are not fringe moves. These are well-structured exits by people who no longer trust that the UK will provide a stable or fair environment for wealth creators. And here's the worrying thing. This exodus is starting to have a ripple effect. The UK government is already under pressure to prevent capital flight. That's why you're now hearing early rumbles about an exit tax. Similar to the US system where citizens who renounce are taxed on unrealised capital gains, the UK could adapt a model that penalises individuals who move wealth abroad or change their tax domicile. If that comes to pass, and it's far more plausible than many realise, it could trap individuals in high tax environments, even as the government continues to raise the burden. And that brings us to the heart of the issue: jurisdictional risk. Right now, too many business owners and investors are thinking in domestic terms. They're planning as though the UK will operate the way it always has. But when your country's debt levels are rising, tax burdens are hitting records, and capital is flowing outward, you need to think internationally. And to be clear, I'm not suggesting everyone move abroad, but I am saying this. Consider diversification, not just of your assets, but of your jurisdictions. That might mean buying property overseas, it might mean holding international stocks through offshore structures, it might mean setting up a second base for your business, or securing a second passport or long-term residency. Because if the UK becomes more aggressive in taxing wealth, capital, or even movement, you'll need to have your options lined up well in advance. The UK is still a world leader in finance, law and innovation, but right now it's navigating uncharted waters, and the direction of travel, politically and economically, is clear. Higher taxes, more regulation and increasing pressure on anyone seen as able to pay. If you're not planning for that now, you're reacting. And if you're reacting, you're already behind. So where does that leave us now? It leaves us at a crossroads. One path leads toward increased government intervention, higher taxes and more regulation. The other leads to greater personal responsibility, strategic international planning and preemptive action. But standing still, doing nothing, it's not a viable strategy. If you're a business owner, now is the time to stress test your operations. Run models at 18, 20 or even 25% at corporate tax. What does that do to your net profit? How much do you lose on employer national insurance hikes? How exposed are you to changes in VAT thresholds, dividend tax increases or business rates? These aren't theoretical questions. These are very real scenarios that could be written up into the next budget. For property investors, it's essential to map out a 3 to 5 year plan. What happens if capital gains tax is aligned with income tax? What if mortgage interest relief is abolished entirely? What if the Bank of England holds interest rates above 4% for another 2 or 3 years? Can your portfolio absorb that? This isn't fear-mongering, it's about preparation. Because here's the thing, smart investors don't wait for the announcement, they plan ahead of time. They diversify, not just to grow, but to protect. And more than anything, they stay informed. Because if you don't understand what's coming, you can't build a strategy to deal with it. And let's not forget, the government isn't just reacting to current conditions. It's trying to future-proof the system. That's why we're seeing consultations on wealth taxes, digital ID systems for asset tracking, and tighter rules on overseas ownership structures. There is a direction of travel here, and it's toward greater visibility, more regulation, and increased state control over capital. Now, for those with significant wealth or long-term goals, this isn't a message of doom, it's a call to action. It's a reminder that the world is big, the economy is global, and your options are wider than what exists within the UK borders. There are jurisdictions right now where capital gains are zero, corporate tax is capped, and residency requirements are light. Some of these regions have world-class infrastructure, stable governments and growing economies. Think Singapore, the UAE, Switzerland, or even certain Caribbean jurisdictions. But moving wealth abroad or diversifying internationally is not something to be done lightly. It requires planning, legal advice, and a clear understanding of compliance. You don't want to fall foul of UK tax rules, especially with the government investing heavily in HMRC's data analytics and cross-border tracking. That's why the conversation you need to be having isn't just with your accountant or solicitor. It's with a strategic advisor who understands international structuring. Someone who can help you assess risk, identify opportunity, and legally position yourself in a way that aligns with your goals. And while not everyone will want or need to leave the UK, having the option is what matters. Just like you wouldn't put your entire investment portfolio into a single stock, you shouldn't anchor your entire financial future into a single jurisdiction. Flexibility is security. Optionality is power. We're entering an era where governments will be forced to make difficult choices, and unfortunately, those choices will often fall on the shoulders of business owners, investors, and wealth creators. Not because it's fair, but because it's easy, because you're visible, because you have something to take. But you do have options. You can adapt, you can prepare, and most importantly, you can act. The UK is changing, and if you want to thrive in that new environment, it's time to change with it. Start building resilience, start asking deeper questions, start thinking globally, because the next 5 years won't look like the last 5, and those who prepare will be the ones who will prosper. As always, thank you for watching. I appreciate you for being a subscriber, and I'll see you again on the next one.